Wednesday morning, 10:15. Dwight is sitting in a leather chair at his bank. Not the teller window, the back office, the one with the door. There's a framed degree on the wall, a family photo on the desk, a coffee mug that says, "Your goals, our mission." He's 63. Operations manager at a utilities company. He's been coming to this office twice a year for 2 decades. Same bank, same handshake, same conversation. "We're keeping you on track, Dwight." And every time he leaves, he feels good, protected, like the people in the building are watching his money the way a doctor watches his blood work. Here's the thing, nobody told Dwight. The man who runs that branch, the one who oversees every advisor, every product on the shelf, every sales target on the whiteboard in the back room, doesn't own a single one of those products. Not one. His name is Mitchell. He's the branch manager. He's worked at that bank for 22 years. He knows every fund, every annuity, every CD rate by heart. He sees the commission structure. He signs off on the quarterly sales reports. And his own retirement portfolio looks nothing like what his branch sells. Nothing. Now, Dwight and Mitchell don't make the same salary. That's not the point. The point is this. They both put away $6,000 a year for 20 years. Same contribution, same timeline, just a different shelf. And when you run both portfolios side by side, same 6,000, same 20 years, the gap between them isn't a rounding error. It's almost $100,000 on the exact same annual contribution. Before you say, well, Mitchell runs a bank, of course he knows more. That's the part that makes this worse. Because what Mitchell did wasn't complicated. It wasn't insider knowledge. It wasn't some hedge fund trick. It was one decision, available to anyone, including Dwight, including you, but Dwight never saw it. And there's a very specific reason he didn't, a reason that has nothing to do with intelligence and everything to do with the building he walked into. So the question isn't whether your bank is lying to you. They're not. The question is whether the product they put your retirement in is the same product the branch manager chose for his. And if it's not, what did that difference cost you? Let's set the terms. Dwight earns $85,000 a year. Mitchell earns more, he runs the branch. But that's not what this comparison is about. This is about one number, $500 a month, $6,000 a year. That's what each of them puts into a retirement account. Same dollar amount, same 20 years, same starting age. The only difference is where the money lands. Dwight's portfolio, built entirely on his advisor's recommendations, looks like this. A quarter of it is in CDs. Another quarter sits inside a fixed indexed annuity. The remaining half is split across 2 actively managed mutual funds the advisor selected for him. Those managed funds carry an expense ratio around 0.85% to 1.1%. On top of that, Dwight pays a 1% annual advisory fee. And when he first bought in, a front-end sales load took 5% off the top of every dollar before it was even invested, all in. His drag on returns is north of 2% a year, and that's before the annuities caps and participation limits eat into the rest. Mitchell's portfolio is 3 lines on a single page. A total stock market index fund, an international index fund, a bond index fund, average expense ratio, 0.04%. No advisor fee, no load, no surrender schedule, no layers, same $500 a month, same 2 decades, 2 completely different shelves. And for the first 3 years, Dwight's shelf actually looked like the smarter choice. That's the part nobody warns you about. Here's what year 1 looks like from Dwight's seat. His CD pays a guaranteed rate. His annuity credits a modest gain, no losses on the statement, not a single red number. His managed funds dip slightly in the fall, then recover by December. The quarterly statement lands in his mailbox with a clean upward line. His blended return across everything shows about 4.2%. He doesn't celebrate, he nods. That's the whole point. Steady, predictable, protected. Mitchell's year 1 looks different. His index funds are up overall, but the international allocation drags. His bond index barely moves. And in the 3rd quarter, the total market fund drops 8% in 6 weeks. His statement doesn't have a clean line. It looks like a heartbeat monitor after a flight of stairs. Nobody calls Mitchell. Nobody sends him a letter with a pie chart. Nobody schedules a reassurance meeting in a back office with a leather chair. Year 2, same pattern. Dwight's statement shows another 4% gain. Smooth, predictable. His advisor calls in January. "Just checking in, Dwight. Everything's right on track. There's a new brochure in the envelope." It has 6 colors and a paragraph that says diversified across asset classes for long-term stability. Mitchell gets an email from his brokerage. It has no colors, it has a number. Year 3. Dwight sits down with his advisor for their semi-annual review. The advisor pulls up the pie chart, points to each slice, and says, "You're allocated exactly where you should be." Dwight leaves the office feeling the same thing he always feels, that someone competent is watching. And this is the mechanism that makes the whole thing work. It's not that Dwight was lied to. It's that every signal, the calls, the statements, the meetings, the language, the building itself was designed to make him feel like he'd already made the best possible decision. Every quarter, the bank reinforced the one thing Dwight needed to feel, that he didn't need to look anywhere else. Mitchell, meanwhile, has no calls, no meetings, no pie charts, no semi-annual reviews, just a number on a screen. His portfolio is up about 6.8% average over those 3 years, but he's also sat through a 12% drawdown in a single quarter without anyone telling him it was going to be okay. And if you put both statements on a table in year 3, Dwight's looks cleaner, more organized, more professional, more reassuring. Mitchell's looks like something you'd rather not open. The gap after 3 years? About $1,800. Barely noticeable. You wouldn't rethink your entire retirement strategy over $1,800. You wouldn't even bring it up. But here's the thing about compound math. It doesn't care what your statement looks like. It doesn't care how many colors are on your pie chart. It only cares what the net return actually is. And the net return after every fee, every load, every cap, every advisory charge is where the two shelves start to separate. Not dramatically, not yet, but the curve is already bending. And in year 4, Dwight gets a document in the mail he's never really read before, a fee disclosure form, 4 pages, small print, dense columns of percentages, and legal language. He usually throws it in the drawer with everything else. This time, he doesn't. Dwight reads the form. And for the first time in 20 years, he sees the layers. His 2 managed funds carry expense ratios of 0.85% and 1.1%. That's the management fee, the cost of paying someone to pick stocks inside the fund. But below that line, there's another fee, a 12B1 charge 0.25% that goes toward marketing and distribution. In plain English, that's the fee the fund charges to pay the person who sold it to him. Then there's his advisory fee, 1% per year, charged on his total managed balance. That's not inside the fund, that's on top of it. Stacked. So on his managed fund allocation alone, Dwight is paying north of 2% a year in total drag. On a $50,000 balance, that's over $1,000 a year, every year siphoned before his money earns a single dollar of growth. And the front-end load? When Dwight first invested in those funds, 5% of every dollar was taken off the top as a sales charge. On his managed fund contributions over 20 years, that's $3,000 that never got invested at all. Gone on day 1 every single year. Then there's the annuity. He bought a 10-year fixed indexed annuity 6 years ago. What he didn't know, what nobody in the back office explained, is that the advisor who recommended it earned a commission between 6 and 8% of the entire contract value on the day Dwight signed the paperwork. On a $30,000 annuity, that's up to $2,400 paid by the insurance company to the advisor before Dwight's first credited interest posted. That commission isn't charity. It's baked into the product structure. It's the reason the annuity has a surrender schedule. If Dwight tries to take his money out before year 10, he pays a declining penalty. The insurance company needs time to recoup what it paid the advisor on day 1. Dwight's money isn't just invested, it's locked. He stares at the numbers. Not because they're complicated, because they've been there the entire time. On every statement, in every annual disclosure, on every page he threw in the drawer without reading. The fees weren't hidden. They were disclosed in 8-point font in legal language inside documents designed to be filed, not read. Technically, everything was legal, documented, available for review. The question isn't whether they told him. It's whether the system was designed for him to actually understand what they were telling him. And that brings us to the second part of this. Why didn't Dwight read the form earlier? He's not careless. He's not unintelligent. He managed operations at a utilities company for 25 years. He reads contracts. He reviews budgets. He catches line items that don't add up. But this was different. This was the bank. There's a term for what Dwight experienced, and it has nothing to do with laziness. It's called institutional trust, and it works like this. You walk into a building with marble floors and a logo etched in glass. There's a man in a pressed shirt behind a mahogany desk. He has certifications on the wall and a firm handshake. He uses words like asset allocation and risk-adjusted return and downside protection. He shows you a chart with a curve that goes up and to the right. He calls you by your first name. And something in your brain shifts. The part of you that would normally ask, wait, how much does this actually cost me per year, goes quiet. Because the environment is telling you something louder than any number on a page. This is where serious people put their money. This is where safe happens. You don't question the doctor. You don't question the building. That's not stupidity. That's design. The language is built to feel protective, not transactional. We're keeping you on track. We're monitoring your portfolio. You're in good hands. These aren't accidental phrases. They're trust architecture. They turn a product sale into a relationship. And once you're inside the relationship, asking about fees feels like questioning your doctor's bill while he's holding the stethoscope. The quarterly calls, the semi-annual review, the brochure with the pie chart, the office with the door. None of it is illegal. None of it is false. But all of it serves one function to make you feel like the decision has already been made and it was the right one. Dwight didn't miss the fees because they were buried. He missed them because the entire experience, the building, the handshake, the call, the language was built to make him feel like he didn't need to look. Now he's looked. And the next thing he does is something he's never done in 20 years. He opens a spreadsheet, he types in $6,000 a year, he types in 20 years, he types in 2 different net return rates, and he runs the math himself. Here's what Dwight sees when he runs the numbers. Year 5. His portfolio, CDs, annuity, managed funds with all fees included sits at about $33,600. Mitchell's index portfolio, same $6,000 a year, same 5 years, is at about $38,000. A gap of roughly $4,400. Noticeable, but not alarming. You could explain it away. Market timing, a rough quarter, a different starting month. Dwight might have shrugged at that number and closed the laptop. Year 10. Dwight's at about $75,800. Mitchell's at $93,600. The gap is now $17,800. That's not a rounding error anymore. That's a used car. That's a year of property taxes in most American counties. That's real money, and it came from nowhere except the difference in what each man paid to be on his shelf. Same $6,000, same decade, $17,800 apart. And here's what makes that number sting. Dwight hasn't made a single mistake. He didn't skip a year. He didn't panic sell during a downturn. He didn't withdraw early to buy a boat. He showed up every single month with his $500. He did everything right on the wrong shelf. That $17,800 isn't a penalty for bad behavior. It's the price of not knowing what was on the other shelf. But here's where compound math stops being polite. Year 15. Dwight's at $129,000, Mitchell's at $175,200. The gap is now $46,100. Read that again. In the 5 years between year 10 and year 15, the gap didn't grow by another $17,000. It grew by 28, almost double the previous decade's difference in half the time. That acceleration is the whole story. It's not linear, it's exponential. Every dollar Mitchell didn't pay in fees earned its own return. And that return earned its own return. And that return earned its own return. 20 years of that, and the curve doesn't bend, it breaks apart. Dwight's hand hovers over the mouse. He almost closes the spreadsheet. Part of him doesn't want to see the last line, but he scrolls down one more time. Year 20. Dwight, $196,373. Mitchell, $294,764. The gap is $98,391. He reads it twice, then a third time, because the number doesn't feel possible. Not on $500 a month, not on the same contribution, not on money that was supposed to be working for him the whole time, almost $100,000. On a total contribution of $120,000 each, same $500 a month, same 20 years. The only difference, the only variable in the entire equation is which shelf the money sat on. Dwight didn't invest less. He didn't start later. He didn't skip years. He didn't panic sell. He just paid more quietly, invisibly, every single year for the privilege of being told he was in good hands. Let that number settle. Mitchell contributed $120,000 over 20 years. He has $294,764. His money nearly tripled itself, and he didn't pick a single stock. He didn't time a single trade. He didn't call anyone. He didn't sit in a leather chair twice a year. Dwight contributed the same, $120,000. He has $196,373. His money grew. It's not a disaster. But almost $100,000 of potential growth was absorbed by the layers sitting between him and the market. Expense ratios, advisory fees, front-end loads, annuity caps, surrender structures. Layer after layer after layer. And right about now, you're probably thinking, well, Mitchell ran a bank. Of course he knew where to put his money. He had insider access. He had training. He had an unfair advantage. But that's not what happened. Mitchell didn't study finance textbooks at night. He didn't read academic journals. He didn't build a custom allocation model. He saw one thing, a scorecard, published every year by S&P Dow Jones Indices. It's called the SPIVA report, and it shows across 20 years of data that roughly 88% of actively managed U.S. equity funds underperform their benchmark index over any 10-year period. 88%. Not a close call, not a coin flip, not a split decision. Nearly 9 out of 10 professionally managed funds run by teams with research budgets, Bloomberg terminals, and Ivy League credentials fail to beat the index they're trying to beat. After fees, Morningstar's own active passive barometer confirms it from a different angle. Over a 10-year window, only 21% of actively managed funds both survived and outperformed their passive benchmark. The rest either closed, merged, or fell short. 4 out of 5 didn't make it. Mitchell saw those numbers from the other side of the desk. He watched his branch sell actively managed funds every week. He signed off on the sales reports, and then he looked at where the returns actually landed. And he made one decision. I'm not buying from my own shelf. That's it. That was the entire advantage. Not insider knowledge, not a proprietary algorithm, not a secret fund, just the ability to see the shelf from the other side and the willingness to walk past it. So why didn't Dwight see the same data? The SPIVA scorecard is free. It's published online every year. The expense ratios are printed on every disclosure. The math is arithmetic, not calculus. The answer is that nobody in the building had any incentive to show it to him. Now, before this turns into a 20-minute accusation, let's stop. Because the bank isn't the villain here. And if Mitchell were sitting next to you right now, he'd tell you the same thing. CDs guarantee your principal. You put in $10,000, you get back $10,000 plus interest, no market risk, no drawdown, no red numbers on your statement. For someone who lies awake at night when the market drops 8% in a quarter, and there are millions of those people, that guarantee has real measurable value. Peace of mind isn't free, and it shouldn't be. Annuities the right kind, bought for the right reason, at the right time, solve a problem that index funds simply cannot touch. Longevity risk, the chance that you live to 94 and watch your savings account hit zero while you're still breathing. A lifetime income annuity pays you every month until you die, no matter how long that takes. No index fund on earth makes that promise. None. And the managed funds? They come with a person, a phone number, a voice on the other end. In March, when the market is down 15% and every headline is screaming sell, that voice says, don't touch it, we've seen this before, stay the course. For a lot of people, more than the financial independence crowd likes to admit that phone call is the difference between holding and selling at the bottom. And selling at the bottom costs more than any advisory fee ever will. The behavioral gap, the returns lost to panic selling, dwarfs the fee gap in a lot of real-world portfolios. Here's the number that puts this in perspective. According to the Federal Reserve Survey of Consumer Finances, roughly 44% of American families don't hold any stock market investments at all. None. No 401k, no IRA, no brokerage account, no index fund, nothing. For those families, the question isn't index fund or managed fund. The question is invest or don't invest. And if the bank, the office, the handshake, the advisor, the pie chart is the reason someone starts putting away $500 a month into anything at all that might be worth more than the fee difference over 20 years. Something beats nothing. Always. The bank is a business. It sells products. Those products have costs. That's not a scandal. That's commerce. The problem was never that the bank charges fees. Every business charges for what it sells. The problem is that the person paying those fees didn't have the information to decide whether they were worth it. And that's a different kind of problem entirely. So, if the bank isn't the villain, why does the gap still exist for someone like Dwight? Because the gap isn't about intelligence. It isn't about discipline. It isn't about how much you earn or how early you started or whether you read the Wall Street Journal. The gap is about one thing: who gets to see the whole shelf? Mitchell, sitting behind the desk for 22 years, sees both sides. He sees the products his branch sells and the fee structures attached to each one. He sees the commission schedules. He sees the quarterly sales targets on the whiteboard. And he sees the data, the SPIVA scorecard, the Morningstar reports, the ICI fee studies that show exactly what those fees do to a portfolio over 10, 15, 20 years. Dwight, sitting in front of the desk, sees one side, the side that's presented to him, the brochure, the pie chart, the projected returns, the reassuring phone call in January, the door that closes behind him every 6 months while someone tells him he's on track. That's not a difference in IQ, that's a difference in view. Mitchell doesn't have a better brain. He has a wider window, and the verdict here isn't banks are bad, it isn't advisors are crooks, it isn't never buy an annuity. The verdict is quieter than that. And more important, if you're paying someone for financial advice, you have the right to know whether they'd follow that advice with their own money. That's not a radical idea, that's the minimum. The FTSE Russell Wealth Survey found that nearly half of investors whose advisors knew about index fund strategies don't recall their advisor ever mentioning them. Not once. Not as an alternative. Not as a comparison point. Just silence on the other side of the desk. And that silence is not an accident. It's a business decision. So the question you should be asking isn't, is my advisor good at their job? It's a different question. A more specific one. It's this: if the branch manager wouldn't put his own retirement savings in the products his team sells every day, what does that tell you about the shelf they put you on? Dwight knows the answer now. He didn't need a finance degree to find it. He didn't need insider connections. He didn't need to confront anyone. He needed a spreadsheet. 20 minutes, and the one thing nobody in the building ever offered him. The view from the other side of the shelf. Dwight closes the laptop. He's not panicking. He's not calling his advisor to yell. He's just doing something he should have done a long time ago. He's reading the other side of the page. Now, this video showed you the gap. $98,391. Same contribution, same 20 years, different shelf, but there's one thing we didn't cover, and it matters if you're sitting where Dwight was sitting 6 months ago. What happens when you try to move your money out of these products mid-contract? The surrender charges, the tax triggers, the early withdrawal penalties. The real cost of switching shelves when you're already 15 years in, that's a different math problem. And it changes the decision completely. If you want to see that math, subscribe. That's the next video. But here's what you can do right now, today, without moving a single dollar. Ask your advisor one question, just one. Are you personally invested in the same products you recommended for me? If the answer is yes, stay. You might be on the right shelf. If there's a pause, you already have your answer. The only number that matters is the one that includes everything.